The US government has begun a partial shutdown after the two houses of Congress failed to agree a budget. Well, the House passed it, but the Senate decided that it would veto. Joe Rundle, head of trading at ETX Capital, joins us from London for more. Joe, it's all about Obamacare. The Republicans don't like it, and they're making this a very big issue. But how have the markets reacted to the news?
Well, I think we've reacted quite calmly at the moment. We obviously saw a big sell-off yesterday as this was coming to a head. But actually today we're digesting it and we're thinking probably the US is not going to completely derail the economic recovery that it's managed to engineer. And actually they will probably find find a solution to this. But having said that, the US have its two very big issues. Obamacare is the real sticking point on both sides, and I can't see anyone backing down without losing face in the short term. So this does have potential to drag on.
The last time we saw this was in late 1995 and early 96, where you had the two shutdowns of government. Are there any lessons to be drawn from what happened that time?
Well, I think the lesson to be drawn is don't do it. It's incredibly damaging for the economy. This one, I think, is particularly worse. The federal government is a much bigger part of the economy now, so it will be incredibly harmful if this doesn't get resolved quickly. However, I think the biggest issue is the debt ceiling on the 17th of October, which is why I think everyone's really digging their heels in over this. If we get up to the wire on the debt ceiling and there haven't been some form of resolution, that's a really major market event, and that's a sort of almost Lehman-esque moment and could cause a real big derailment.
So the fact that they can't come to terms over government employees, even though 1 million of them are going to be leaving and not working with or asked to work with no pay, 800,000. You can just imagine what would happen in South Africa if 800,000 state employees were told, sorry, you've got to go on unpaid leave as of now until the politicians sort things out. That is one part of this whole party. The other thing, as you say, is the 17th of October. Now, if they don't reach agreement there, what are the consequences likely to be?
Well, you're going to have a technical default of the US government on its interest payments. It just physically won't be able to pay them. Beyond that, I mean, it would make Lehman look like small fry, and we would probably be in a significant market meltdown. So I think that's really serious. And that's why we haven't seen a major sell-off today on this shutdown, because people are seeing it as a prequel to the debt ceiling, and as long as people can get the negotiations out and make their points and score political points over each other in this 17-day period, as long as they sort that out, this, even if it drags on for a week, can probably be contained.
But it is uncertainty, and markets hate uncertainty, Joe.
Yeah, absolutely. Markets really hate uncertainty, and I think you're seeing this ramping up, and then actually the European issues becoming quite a big problem again. Everyone thought the Eurozone crisis had solved itself. Actually, Italy's chucked in a bunch of uncertainty into the market. So I do see a really volatile couple of weeks, certainly, while you've got US political and Italian political decisions all trying to derail what seems to be a beginning of a sustainable recovery, a worldwide economic recovery.